What's up, everyone? My name is Ale. Welcome back to my world of stocks, and welcome back to my 3 stocks on sale series, where I use all of the current market volatility to find you guys 3 new stocks in each episode that I think are trading on sale at today's prices for the long term. And to make things even more fun and interesting, I specifically look for one low risk, very large and dominant stock, one medium risk dividend stock, and then one high risk, more kind of speculative stock, just to give you an even wider variety of risk versus reward type of stocks to look at for your consideration. As always though, just keep in mind that we only do this for fun to show you what's available and out there in the market. So always do your own research and make your own decisions. But if you're enjoying the series and you appreciate me trying to find you different stocks to look at every time, then please consider subscribing to the channel, maybe even hitting the like button on the video. Those 2 things really help this channel survive, and it means a lot to me. But with all that said, let's jump into today's fresh new list of stocks. Okay, and as always, we'll be starting with our low risk option first, a very dominant company that is likely to perform well over the long term because of their massive size and strength, but that is also currently down in their share price and is looking more attractive because of it. And really, right now, there's no other stock that I think is looking better than Google, ticker symbol GOOGL. I mean, you're talking about a massive Goliath here that almost never dips, but it's currently going through one of the biggest buying opportunities that I think you'll ever see in your life, as it's not only right next to the very bottom of its 52-week range, but it's currently down close to 30% from its highs. That's over a quarter of its entire value being lost, and you can see how dramatic it is just on this decade-long chart here. And if you think this is normal for a company like Google, you have to consider that it's currently trading well below even the lowest, most bearish analyst price targets, and that's out of 45 different analysts. So it's not like it's just a few crazy analysts that don't know what they're doing. This is a huge amount of experts that think it should be trading way higher than it is. And when you look at their valuation, I mean, I think it makes perfect sense. Google is now cheaper than not only their own 5-year average, but even the entire sector. Do you have any idea how ridiculous it is for a world leader like Google to be even cheaper than the sector? This is a company that has #1 market share in some of the largest markets in the entire world, like digital advertising, internet search, internet browser, mobile operating system, and even all platforms operating system, not to mention the huge presence in cloud computing and artificial intelligence, or their subsidiaries like YouTube, which you're watching this video on. And as a standalone company, you know, YouTube could be worth hundreds of billions of dollars, maybe even $500 billion by some estimates if it was spun off from Alphabet, which is insane considering they purchased it for only around $1 billion in 2006. That's crazy. And there's still so many other areas for Google to grow in. I mean, Android itself competes directly with Apple's iOS, yet it has more market share, and the Google Pixel phone is quickly becoming one of the most popular alternatives to an iPhone. It's still very small, but it's growing, which they've also added a watch and earbuds to their ecosystem too, just like, you know, same playbook as Apple. And yet Apple is actually valued much higher with a market cap that is over $1 trillion more expensive than Google. Look, don't get me wrong, obviously Apple products are way more popular. I'm not making that argument. And Apple's business is much stickier in that area, you know, specifically. But Google still has a lot of future potential there. And in my opinion, they're massively more diversified than Apple as an entire business. So trading at over $1 trillion less, I think is ridiculous. That's my opinion. But overall, when you look at Google, you're talking over $250 billion in sales, close to $80 billion of net income profit just last year alone, and yet they're still growing by double-digit percentages. It's pretty mind-blowing to me that this company is still trading this cheap with that kind of performance. I don't personally get it. I feel like Mugatu from Zoolander when he says,
"Doesn't anyone notice this? I feel like I'm taking crazy pills."
But I just look at Google stock and I look at so many other stocks that I think are very poor choices that people love to gamble on. And I can't believe that there's serious long-term investors out there that don't have Google stock in their portfolio. I mean, if I own too many stocks, I would sell something to make space for it. If I didn't have the budget, again, I would sell something or I would just buy fractional shares. But really, there should be no excuse. Serious long-term investors should have space for Google stock in their portfolio, and I know I do, and it's a stock that I really believe in long-term, but that's just my opinion. Okay, moving on though to stock number 2, that's going to be our medium risk option, which includes a dividend to help lower the risk a little since we know that a falling stock price can mean a rising yield. And this time I'm going with a stock that I have never owned myself. In fact, I don't think I've ever even talked about them on the channel before, but I think this is a very solid option here, and it's a stock that I'm becoming more interested in myself by the day, and that is Broadcom, ticker symbol AVGO. Now, this is actually a semiconductor company, but it's a little different than you would typically think of in terms of companies like AMD or Intel, and I'll explain why in just a second. But when looking at the stock, it's been absolutely crushed this past year, just like most other semiconductor stocks across the market, with Broadcom in particular losing more than a quarter of its value from its highs. Now, normally this is a very strong performing stock year after year, and I should note that some of the risk does come from the fact that it's still trading higher today than pre-pandemic levels, even after the recent crash. But regardless of the actual share price itself, Broadcom's valuation is still extremely cheap right now with a PEG ratio below 1, which is generally, always considered a great value, but it's also more than 20% cheaper than its own 5-year average and more than 40% cheaper than the sector as well. That's pretty darn cheap. And with the crash in the stock price, also comes a rising dividend yield that is now well above 3%, which is not only higher than their 1-year, 3-year, 5-year, and 10-year averages, but it's also growing at a gigantic rate of 35% with a decade of consecutive growth, which was actually when they started paying the dividend. So they've been growing it every single year since they started paying it, and yet their payout ratio is still low at less than 50%. I mean, this is just a fantastic growth-oriented dividend overall. Pretty much everything you look for with already a very high yield. So just from the valuation and dividend standpoint, I mean, I would say that it already looks very attractive. But going back to the business for a second, Broadcom basically develops custom chips for businesses rather than directly for consumers. And this ranges from things like storage to internet connectivity, but it's even branching out into software too, which includes the planned acquisition of VMware to better diversify its business and not be so susceptible to the volatility and cyclicality of the chip market, which, by the way, who cares about that volatility anyway? I mean, people are so concerned about chip demand and chip shortages, but I just think those are dumb short-term concerns. We all know that these chips are going to be one of the most widely used and most, widely needed components of the future. All this short-term stuff, in my opinion, is just noise. But when looking at the acquisition, that, by the way, is of a cloud computing giant that does everything from infrastructure to services, apps, cybersecurity, and networking, all of which are markets that Broadcom can expand further into themselves with their own products. So I think you're going to see a lot of cross-marketing, a lot of, cross-benefits, synergies going on, and it's going to make it even easier for both companies to grow if this deal does get approved. Speaking of growth though, sales already grew by a huge 15% last year, and yet they're still projected to soar by another 20% plus this year before finally correcting back down to mid-single digits. But all the meanwhile, profits are expected to grow on average by over 15% over the next 5 years, which is the same fantastic growth that they saw in the previous 5. And all these different positives that I've outlined for you are exactly the reason why analysts are way more bullish on the stock than its current price. It's even cheaper than even the lowest, most bearish, price targets as of right now. So I just think overall with a stock like Broadcom, you not only get a cash cow that operates in literally two of the best, biggest markets of the future in semiconductors and cloud computing, but you also get one of the best growth-oriented dividends that is out there in the market as well. And on top of that, you get it all for a great valuation. I mean, what's not to like about Broadcom? I'm actually thinking about buying the stock myself, and that's coming from someone who already owns a lot of companies, probably too many companies that already give me plenty of exposure to the markets that Broadcom operates in, but it's just that good. I mean, I'm tempted myself to pick it up maybe sometime soon. All right, guys, that's going to leave us now with the third and final stock, which is also our high risk option. And for this one, I mean, Google is such a great stock right now, right? Well, how's the Chinese version of that doing? The answer is it too is looking extremely cheap. I mean, I could make a decent case for Baidu stock almost just by looking at the stock chart. You can see that it's definitely gone through its struggles, just like literally every other Chinese stock recently, but every time that it dips down to around this low, $100 range, it tends to practically double or even triple from here, and I think there's very good reason to believe that it can do it again. Whereas Google dominates the US markets, Baidu dominates much of the Asian markets. In China, they hold by far the most search market share, and it's not even close at over 65%, while the next closest is Bing at 10%, and Google is all the way down to just 3%. And I highly doubt that China is going to ever let American companies like those ever surpass Baidu. So their market share is pretty safe if you ask me. It's super popular to use Baidu, and I just don't see that going away. Plus, they dominate online advertising with other giants like Alibaba and Tencent that together make up over half the market, and they're the fourth largest in cloud computing as well, which is a market that, despite the horrible macroeconomy in China that continues to be weighed down by their own zero pepperoni policies, it still managed to grow by over 30% at the end of last year and is expected to continue growing by 25% thereafter as well. But it doesn't even stop here. Baidu also has an autonomous driving subsidiary called Apollo that is further ahead than all the competition in the country. In fact, they're the first company to receive a robotaxi license and plan to already release a completely driverless robotaxi service by next year. Why is that important? Well, according to HIS Market, which is an analyst firm that is now merged with S&P Global, more than half of all mobility travel in China is expected to be driverless, basically robotaxis, by 2030, reaching over $1 trillion yuan in size. And Baidu is expected to be the #1 market share leader of it. And yet, despite how massive of an opportunity that is, that's not even the main reason why I own Baidu stock myself. I mean, of course, I own it for all these different reasons put together, but the biggest of them, or at least where I see like the most long-term future potential, is in what they're doing with artificial intelligence. First of all, we all know that China has ambitions of basically like dominating, or at least being one of the biggest, dominators of the world by 2050. Whether they can actually achieve that, or to what degree, it's obviously up for debate, and there's a lot of things to talk about there. But the point is that even if they want to have a chance of accomplishing some of their ambitions, they're going to need to be one of the biggest players in artificial intelligence, which is a market that is expected to surpass $1 trillion within this decade. And from there, I think it's only going to skyrocket in terms of importance and value. But if China wants to dominate it or be, one of the biggest players, they absolutely need Baidu to be successful. Why is that? Well, Baidu gives them their best shot. Not only do they own those giant cloud computing and autonomous driving divisions that will play large roles in artificial intelligence, but we also know that AI will be extremely dependent on infrastructure and chips. Well, Baidu already makes their own AI chips that compete directly with companies like NVIDIA, and they have their own deep learning platform called PaddlePaddle, which was recently ranked as #1 in terms of market share in China by the IDC, the International Data Corporation, which is like a leading firm in data research all around the world. And they reported that Baidu has now surpassed both Google and Facebook and literally every other company in China in terms of market share. Speaking of which, Baidu also has the #1 market share of AI patents, but it's not just in China, it's for the entire world. That's pretty crazy. Now, obviously, all of these things sound great, but it's still extremely high risk of a stock for several reasons. Not only is Baidu a Chinese VIE company that gives you, very little rights as a shareholder in terms of, talking about the stock, but it was also named as one of the many Chinese companies on the SEC's potential ban list if they don't start providing more transparency. Personally, I don't think giants like Baidu or Alibaba or Tencent are going to get banned from the US anytime soon in terms of investing in their stocks. And one of the reasons why I believe that is because we know that the US and China have been working on fixing those issues, but it's still something that could be, a devastating blow in a worst case kind of scenario. On top of that, China itself is a struggling economy right now, and that's resulted in lower advertising sales, which have directly hurt Baidu, with revenue expected to decline about 3% this year before returning to double-digit growth next year. But that's being priced into the stock right now. And as we all know, guys, you're not going to get a great price in a stock without having to take on significant risks. There's always going to be a reason why a stock is down, but that's where you get the opportunities. And that's what I think we're seeing with Baidu. And look, I get it. It's a Chinese stock. There are people who wouldn't even consider touching a Chinese stock, and I don't blame them at all. I mean, I think that they're probably doing the smart thing. They're being cautious with their money, which you should do. And if you prefer, you know, a more cautious kind of similar play in this, well, I gave you one at the start of the video. Google. I think Google is a great play, and it's much safer and much better. Baidu is a little different. You know, obviously a lot riskier, but also has a lot of reward potential too. So it just kind of depends on what your risk tolerance is. It depends on what you're looking for. But I personally own both Google and Baidu stock. Much, you know, a small position in Baidu, and I'm very cautious with it. But I still think that both stocks are worth owning. But that's just my opinion. I'd love to hear what you guys have to say down below. What are your thoughts on all of this? Do you like any of the stocks I mentioned in today's video? Or are there any other stocks that you think I should include in the next episode? Make sure you let me know down in the comment section, and I'll definitely consider them. But thank you so much for stopping by and for all the support. It really means a lot to me. I hope you're all doing well, and I will catch you in the next one. Take care. Bye-bye.